Last week, my friend told me she started investing. I was excited. I asked her, "What did you invest in?" She said, "Mutual funds." I said, "Cool, but which one?" She stared at me like I did ask her to solve a math problem. Here's the thing, saying you invested in a mutual fund is like saying you ate food. Yeah, but what food? Pizza, salad, ice cream. They all are food, but they are totally different, right? Today, we are going to break down main types of mutual funds in a way that will make you go, "Oh, that's what that means." Ready? Let's go. First, let's get the basics straight. A mutual fund is basically when you and a bunch of other people pool your money together and a professional manager takes all the money and invests it for all of you. Think of it like ordering a food with friends. Everybody chips in, someone will place the order, and you all share the meal. But here's where it gets interesting. Like there are different kinds of cuisines like Italian, Chinese, Indian. There are different kind of mutual funds. Each type invests your money in different places. Let's break them down. First up, we have equity funds. Now don't let the word scare you. Equity just means shares of companies. Equity funds invest your money in the stock market and buy small pieces of different companies. Equity funds are higher risk, higher return investments. They can go really high and give you an amazing results, but also can drop and make your stomach flip. These are for people who are willing to stay invested for a long term, perfect for those aiming to reach bigger financial goals and have a higher risk appetite, want to grow their money faster than a savings account or a FD ever could. If your money is sitting in your account earning peanuts and you wouldn't need it for a while, then equity funds might be your right. But here's the deal. Short term, bumpy. Long term, history shows they usually do pretty well. It's like planting a tree and you don't check it every day and let it grow. Now, not everyone needs a higher risk, higher return strategy. Some people prefer the predictable, steady and no surprises. That's debt funds. Debt funds don't invest in companies. They lend money to governments, big corporations, banks and earn interest on it. Just like when you put the money in fixed deposits and the banks pay you the interest, except debt funds do this in multiple places. These are for people who want their money to be in lesser volatile market, for investors with lower risk appetite, willing to stay invested for a short term period of time, want something better than a saving account but less wild than an equity market. Think of debt funds as your steady friend who always shows up on time. Not the most exciting but reliable. The returns usually better than your savings account and less aggressive than equity funds. But you sleep better at night. Okay, so what if you wanted both thrill and safety? Enter hybrid funds. Hybrid funds are like making smoothie with multiple fruits. They mix debt and equity together. Some of your money goes into stocks and some goes into safer options. It's perfect for people who say, "I want some growth, but I also don't want to panic every time the market sneezes." The cool part, there are different mixes. Some hybrid funds are aggressive. More equity, less debt. Some are conservative. More safety, less thrill. You pick based on your comfort level. It's like choosing your coffee. Want it strong? Go aggressive. Want it mild? Go conservative. Either way, you're getting coffee. Last but not least, we have money market funds. These funds invest in low risk, short term debt securities like treasure bills, commercial papers, and certificate bond deposit. They aim to provide investors with high liquidity and capital preservation while offering modest, stable returns. We are talking about the things that mature in few days or months. Think of it like a smart place to park money for you might need it soon. These are great for emergency funds, conservative investors, money you're saving for something coming up in the next few months, times when you want to keep your money working but need quick access to it. The returns are massive, but that's not the point. The point is safety and easy access. It's like a savings account's cooler cousin. usually gives you a better returns while keeping you money safe and available. Here is something many people miss. You don't have to just stick with one fund type. Think of your money like apps on your phones, each serving a different purpose for your financial needs. Some investors split their money into equity funds for their long-term growth, debt funds for stability, and hybrid for balance. The real art is choosing your smart combinations that fit your goals and comfort level. For instance, an emergency fund is better off in safer investments, while retirement funds are likely suited for the long-term growth. Platforms like Labh help make this easier. Labh baskets spanning equity, debt, and hybrid are built with quantitative models designed to select funds showing high performance and low volatility based on years of rigorous data analysis. You get access to diverse options tailored for different needs, helping you to take the guesswork out of your fund selection. Next time when someone asks about mutual funds, you won't just nod. You'll know what you're talking about and why your choices work for you. Remember, finding the best fund is really about what's right for your goals, risk, and your timelines. And if you want to see how these quant-driven baskets work to simplify these choices, platforms like Labh can help you guide your journey without trial and error.